There's a fundamental fracture in the global commodities market right now. If you are looking at the spot price of silver, you are being actively deceived by a paper illusion. Over a recent measured period, we watched the spot price of silver plummet by 37%. Traditional retail investors panicked. Algorithmic trading desks triggered stop losses. The mainstream financial press declared the precious metals bull run dead. But while the retail tourists were selling their paper contracts at a loss, the deepest pockets on the planet were quietly executing the largest physical accumulation of our lifetime. While the price crashed 37%, $9 billion worth of physical silver was systematically drained from the COMEX. Let that sink in. Real physical metal vanished from the vaults, delivered into private, unlisted depositories, exactly while the screen price was collapsing. To understand this paradox, we have to look under the hood. What you see on your screen is not the price of silver. It is the price of a silver derivative contract. The market is currently operating on an extreme fractional reserve basis. For every physical ounce in a vault, there are hundreds of paper claims, trading hands on digital exchanges. When institutional entities want to drive the price down, they flood the futures market with thousands of naked short contracts. This creates an artificial supply shock that exists solely on computer screens. But the smart money uses that artificially suppressed paper price to take physical delivery. They smash the digital price, step into the physical market, and load the metal onto trucks. This is not a conspiracy. This is basic exchange mechanics, and the COMEX vaults are bleeding out at a historic rate. Entities realize that paper contracts will not run electric vehicles, build solar panels, or protect against fiat debasement. The vaults look empty because the physical reality is finally overcoming the paper illusion. To fully grasp the magnitude of this $9 billion exodus, you need an advanced understanding of vault classifications. The COMEX divides its physical inventory into two main categories: eligible and registered. Eligible silver simply means the metal meets the exchange's purity and size requirements and happens to be resting inside an approved vault. It is stored there, but it is not for sale. It belongs to private individuals, family offices, or corporations. Registered silver, on the other hand, is the lifeblood of the pricing mechanism. Registered metal is the silver that has warrants attached to it, meaning it is actively available to settle futures contracts. When you hear that the vaults are empty, we are specifically looking at the registered category. In recent months, we have seen registered silver inventories plummet to levels not seen in decades. We have seen periods where the total registered category fell below 30 million ounces. To put that in perspective, global industrial demand requires over 1 billion ounces per year. When $9 billion in silver leaves the system, it usually follows a specific migration path. It moves from registered to eligible, and then out the back door entirely via armored transport. This massive drain is completely unprecedented, and it is being driven by a profound structural global deficit. For 4 consecutive years, the world has consumed more silver than it has mined. The Silver Institute recently reported a structural deficit exceeding 200 million ounces in a single year. Where is it all going? The green energy transition is an absolute silver black hole. A typical electric vehicle requires up to 2 ounces of silver, double that of an internal combustion engine. Photovoltaic cells, the core components of solar panels, are consuming over 140 million ounces per year. Furthermore, the military-industrial complex is completely dependent on silver for missiles, radar systems, and satellites due to its unparalleled electrical and thermal conductivity. None of these industries can operate with paper silver. They need the physical element. When industrial buyers see the COMEX price drop by 37%, they do not wait for a bottom. They execute what is known as an exchange for physical transaction. They take their futures contracts off the exchange, settle them privately, and pull the metal from the vault. This aggressive offtake is exactly why the paper price and the physical reality are violently diverging. The COMEX is operating as a subsidy mechanism for massive industrial conglomerates, allowing them to drain $9 billion of the world's most critical industrial metal at wholesale liquidation prices. But this game of musical chairs only lasts as long as there is metal in the registered vaults, and right now, the music is slowing down. The mainstream assumption is that if demand increases and physical vaults drain, miners will simply dig more silver out of the ground to meet the shortfall. This reveals a fundamental misunderstanding of silver geology and global mining economics. Silver suffers from what economists call highly inelastic supply. Approximately 70% of all silver mined globally is a byproduct. It is not mined on purpose. It is extracted accidentally during the mining of lead, zinc, and copper. Because silver is just a bonus byproduct for these base metal megamines, their production does not respond to silver price signals. If the price of silver goes up 50%, a massive copper mine is not going to increase its primary copper production. Their operations are dictated by the copper market, not the silver market. For the remaining 30% of primary silver miners, the situation is grim. We have officially hit peak silver. We are no longer finding massive, high-grade, near-surface deposits. Over a century ago, miners were pulling ore out of the ground that contained 30 to 40 ounces of silver per ton. Today, the global average ore grade for primary silver mines has collapsed to roughly 3 to 5 ounces per ton. Miners have to move 10 times the amount of dirt, using diesel fuel that costs twice as much to get the same amount of metal. Capital expenditure in the mining sector has been starved for over a decade. It takes an average of 10 to 15 years for a discovery. Even if silver went to $100 tomorrow, we would not see a meaningful increase in global supply for at least a decade. The supply is locked. Therefore, we have a violently inelastic supply curve crashing head-on into an aggressively expanding industrial demand curve. This is compounded by retail and institutional investors fleeing dying fiat currencies. This is the recipe for a violent upward price dislocation. The $9 billion that just left the COMEX is the smart money mathematically recognizing that the physical supply cannot be replenished. The vaults are not just empty on paper. They are empty because the earth is yielding less metal, and humanity is consuming it faster than at any point in history. The physical reality of silver is about to meet the market price. This brings us to the ultimate question. If the 37% drop is fake and the COMEX is bleeding dry, what is the true, fair market value of physical silver? Why does the underlying math point directly to $75 per ounce as a conservative baseline? First, we must look at the gold to silver ratio. It is the most reliable historical indicator of silver valuation. Geologically, silver comes out of the ground at a ratio of about 8 to 1 compared to gold. Historically, for thousands of years, monetary systems priced the metals at a ratio of 15 to 1. Today, the paper market artificially holds that ratio somewhere between 80 to 1 and 90 to 1. It is a historical anomaly. If we assume a gold price of $2,400 an ounce and we simply see a reversion to the modern historical mean ratio of roughly 40 to 1, that immediately puts silver at $60 an ounce. Second, we must calculate the shadow of inflation. Silver hit a nominal all-time high of $50 an ounce in the year 1980. It hit $50 again in the year 2011. If you take that 1980 high of $50 and adjust it using the government's own conservative consumer price index data, the true inflation-adjusted all-time high for silver sits well above $130 an ounce. A target of $75 is not a moonshot. It is merely half of its inflation-adjusted historical peak. Finally, the physical deficit pricing model demands a repricing. When an asset runs a structural deficit of over 200 million ounces annually, the only mechanism to destroy demand and balance the market is a drastically higher price. $75 is the minimum price threshold required to incentivize heavy recycling of consumer electronics and force industrial users to seek alternatives, though for many technologies, there simply is no alternative. The paper price says one thing, but the disappearing $9 billion in physical inventory says $75 is the inevitable clearing price for the physical market. We are witnessing the terminal phase of the great paper-silver illusion. You cannot print silver, you cannot engineer it in a laboratory, and you cannot satisfy the heavy industrial demands of the 21st century with digitally hypothecated contracts. The 37% crash was a final gift, a window of opportunity engineered by algorithmic manipulation, eagerly absorbed by the smartest money on earth. They took $9 billion of real wealth out of the system, while retail investors looked the other way. The COMEX faults are mathematically failing. When the paper shorts finally lose control, the violent repricing to $75 and beyond will happen virtually overnight. The gap between paper fiction and physical reality is closing. Ensure you are holding the real asset when the two finally collide. Thank you for watching. If you want more deep dive macroeconomic analysis, please like, share, and subscribe to the Fault Line Finance channel. And I will see you in the next breakdown.